What if I told you that the average Sydney house could cost $2.4 million in just 6 years? That Brisbane and Adelaide prices might leap 70%. This isn't scaremongering, it's a sober projection from one of Australia's most trusted property analysts. While you're reading this, the market is moving. Every month you hesitate, the price of entry climbs by thousands. This is your final wake-up call. Understand the 3 irreversible forces locking in these prices, or accept that home ownership may slip beyond your reach forever. Part 1. The inescapable math, the 2030 projection explained, forget vague predictions. In early 2024, PropTrack REA Group performed a simple but staggering piece of analysis. They modeled what would happen if the explosive growth patterns of the last 5 years simply repeated themselves until 2030. The results are not a forecast, but a trajectory, a flashing red light showing where we're headed if nothing fundamental changes. Sydney, the average house price could approach $2.4 million, a rise of nearly $1 million from today. Brisbane, up 68%. Adelaide, up 75%. Perth, up 66%. Melbourne, a more modest but still significant 17%. Hobart and Canberra, up around 40%. Crucially, this projection overwhelmingly applies to houses, not units. The model suggests a mere $80,000 rise for Sydney apartments over 5 years. This underscores the great Australian housing divide, the accelerating gap between land-rich assets and everything else. The Australian dream of a detached home is not fading. It's transforming into a hyper-exclusive asset class, while high-density living becomes the permanent default for more people. The instinct is to dismiss 2030 as the distant future, but you are closer to 2030 than to the start of the COVID pandemic. This is a 6-year financial horizon, the same as a university degree or a car loan. The time to act is not someday, it's within this current market cycle. Part 2, the 3 unshakable pillars making it possible. This projection feels extreme because we underestimate the engine driving it. This isn't speculation. It's built on 3 concrete, interlocked pillars showing no sign of crumbling. Pillar 1, the chronic shortage we can't build out of. Australia has a structural housing deficit measured in the hundreds of thousands. For decades, construction has failed to match population growth. Even with best intentions, fixing this is a 10-year project plagued by planning delays, skilled labor shortages, and high costs. The demand, however, is immediate and relentless. Pillar 2, relentless demand via population momentum. Demand isn't abstract, it's people needing a roof. Rebounding immigration combined with natural household formation, Gen Z, separations, creates a constant, inelastic need for housing. People must live somewhere. In a shortage, this sheer competition pushes prices up, full stop. Pillar 3, the equity engine, the market's jet fuel. This is the most critical, misunderstood force. Existing homeowners are sitting on a monumental pool of equity, often hundreds of thousands of dollars from decades of growth. This isn't paper wealth, it's actionable capital that fuels the market's next phase through equity recycling. Here's the chain reaction. A family sells their home for $1.2 million, owning $800,000 outright. They use that equity as a colossal deposit to upgrade to a $1.6 million home, setting a new price benchmark. The seller of that $1.6 million home now has even more equity to roll into a $2.2 million property. This isn't new money entering the market, it's existing wealth being recirculated, creating a self-perpetuating upward push. It's why prices that seemed insane 2 years ago are the accepted baseline today. These pillars form a feedback loop. Shortage creates competition, competition pushes up prices, higher prices create more equity, which gets recycled to push prices higher again. To believe the 2030 model is impossible, you must believe this entire engine will seize within 6 years. The data suggests it's only accelerating. Part 3, the $150,000 mindset trap. Mini-cycle thinking. You see the trajectory, you understand the engine, yet a cautious voice persists, but interest rates are high. The news says the market is cooling, I'll wait. This voice is your wealth's greatest enemy. It's called mini-cycle thinking, and it costs people hundreds of thousands of dollars. Mini-cycle thinking is fixating on short-term, noisy variables, monthly price dips, interest rate moves, sensationalist headlines, and letting them dictate your long-term strategy. It's watching a single tree while the forest grows relentlessly around you. Here's the trap in action. In 2022, as rates rose, the mini-cycle thinker declared, "The crash is coming. I'll wait." They paused, prices stabilized or dipped slightly. Headlines screamed, "Market turns." They felt vindicated. But by late 2023, the market wasn't crashing, it was surging. The person who waited 18 months for the crash now faced a market $150,000 more expensive. They saved on a slightly higher interest rate but permanently borrowed more principal because the entry price had soared. This mindset fails because it confuses volatility with trend. Property doesn't go up in a straight line. It runs, pauses, and runs again. The pauses are mini cycles. The long-term trend, however, is governed by the deep fundamentals: the shortage, the population growth, the equity engine. Interest rates can temporarily slow the speed of the train, but they don't change its destination if the track remains the same. Escape requires a fundamental flip. Stop trying to time the market. Focus on time in the market. The wealth wasn't built by those who perfectly bought at the bottom and sold at the peak. It was built by those who got in, held through cycles, and let the long-term trend work for them. Your goal isn't to buy at the perfect moment in 2024. Your goal is to secure a position on the 2024-2030 trajectory. Part 4, your action plan. What to do now. Knowledge without action is useless. Here is your situational blueprint. For the first home buyer, your prime directive is entry. Stop waiting for the market to accommodate you. Shift from buying my dream home to securing an asset that gets me off the rental treadmill and into the equity game. Reassess must-haves. Prioritize a land component, townhouse, apartment, or an entry-level suburb over your ideal location. Compromise on the property, not the potential. Use quiet periods. When negative news slows competition, that's your window. You have more negotiating power now than when the herd returns. Consider rent vesting. Buy an affordable investment where you can, rent where you want to live. Get into the market. For the existing homeowner, leverage your position. You are on the ladder. Use it wisely. Know your equity. Get a formal valuation. This is your strategic war chest for upgrading or investing. Plan your upgrade strategically. Your next move should be a 10-year hold in a location with strong fundamentals: land scarcity, amenity. Trade up in land value, not just size. If investing, think fundamentals. Use equity to acquire properties in markets with clear supply-demand imbalances and strong rental yields. Let logic, not emotion, guide you. For the investor, ignore the noise, focus on the trend. Your mindset must be built on pillars, not headlines. Look past monthly dips. Focus on vacancy rates, population data, and infrastructure pipelines, the metrics that matter for a 10-year hold. Debt is a tool in a higher rate environment. Target properties where the rental yield helps service the debt. Structure for safety buffers, but don't be paralyzed. Due diligence is non-negotiable. Get every inspection, scrutinize every report. Mistakes in a moderating market are costlier. For everyone, the universal step is education and advice. Speak to a qualified, independent financial advisor and a broker who understands strategic wealth creation, not just transactions. Build a team for the long game. Conclusion: the only question that matters the 2030 modeling is less about a specific price and more about a powerful truth. Time is your most crucial and non-renewable resource. The 6 years to 2030 will pass regardless. You can be a passive observer, watching prices move beyond reach, or an active participant, allowing compounding growth to work for you. The question isn't, do I believe Sydney will hit $2.4 million? The market's direction, driven by undeniable fundamentals, is clear. The only question that matters is, what am I doing today to ensure I'm in a stronger position in 2030, no matter what the price tag says? Start now, save aggressively, educate relentlessly. Make a plan. The window to act is still open, but with every passing month, it gets smaller and more expensive. The future of Australian housing is being written right now. Make sure you're not just reading the story, make sure you're in it.